Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.
Welcome back to the Sparta Market Outlook Podcast, your inside track on the latest in the global energy markets. I'm your host, Rachel Williams, and today we're diving into the detail of the physical oil market. So look, there's a lot to unpack as usual, from OPEC supply hikes to potential bearish turning points in the distillate market and in the low sulfur fuel oil market. So joining me are Jorge, James and Neil this week. Hi guys, how you doing?
Good morning. Very well, thanks. Yourself?
Yeah, good. Okay, so let's get into it. So as usual, let's start with a bigger news piece that's hit at the weekend, which is obviously OPEC plus. So Neil, do you want to give us an update there, please?
Yeah, so the big news, of course, at the weekend was confirmation, if you like, that OPEC will do a bigger hike in June again, which follows on from bigger hikes prior months as well. So the market didn't react very well, of course, and it's almost as though that has become more of the focus in the market than, the whole tariff demand story. I was going to say the market's more worried about OPEC now, but I think, it's basically a combination of both. There's many impact. First of all, we don't need to talk about the sort of motivations that much because I don't think it brings us much closer to what will happen to the market itself. But obviously, it's a nice time to have lower prices for the consumer.
Yeah.
And, you're already starting to get revisions in all of these forecasts that the market takes, or at least looks at, even if it doesn't take too seriously. So things like the STIO US crude supply forecast, they're coming down already. So that's obviously one of the main benefits, so to speak, from the OPEC perspective of doing this, as they start to crimp the non-OPEC guys over the next couple of quarters. So that's what the market's thinking about.
Okay.
Maybe I go into it later in the crude section, what I think this actually means short term, but let's save that for in a couple of minutes' time. I think there was also a reaction or a non-reaction maybe in the product markets. You guys can maybe talk about it a bit. I had the impression that light ends cracks even went up a bit more. There's many reasons behind that. I suppose there's also a potential price story there in terms of lower prices is better for driving, but that's very speculative, I suppose. But the one message I wanted to get across, and which we'll talk about all day in this pod, is that the margins look good. Simple margins look great. Cracking margins look great. So in your balances, you're expecting, globally speaking, higher run rates coming out of the turnaround season. And what does that mean for your product balances over the summer? Are they now looser than you otherwise would have expected? And that's basically the question going forward.
Fair enough. Very much looking forward to, especially hearing on the distillate side, kind of the impact of that. And welcome back, James. Hope you had a great holiday. But look, before we delve into kind of the clean product side, Neil, while you're on a roll and building upon kind of, the short-term implications of OPEC plus as well, let's stick with the physical crude market for a couple of minutes. So what's the immediate outlook, do you think? Because we know crude's in contango, down the curve. What about the direction of the prompt?
Yeah, it's just an interesting time, let's say, for this to happen. So there's maybe 3 points, two main points I would make. The one thing that the market needs to have more clarity on is what does that actually mean for OPEC exports? So it's a kind of open secret that, let's say, the official supply numbers are maybe slightly lower than what the market has seen for a long time. So there's a kind of realization from the market that some of the hikes are only on paper. It's a kind of closing of the gap between real supply and official supply from some players. So there'll definitely be a higher Saudi supply and exports, presumably, all else equal. But I think there's an element of the market realizing or needing to see what the real supply hike is over the next couple of weeks. So we don't get that information until let's say after the fact or later next month. And then there's some seasonality to think about, right? So we've just talked about high runs. It's anyway seasonally high over the next couple of months. Margins are looking good. So just from that perspective, I don't necessarily need to see crude heading into contango, let's say, anytime, or prompt spreads into contango anytime soon. And the one other thing I just wanted to note is that the medium crude market is actually quite tight, right? So there's been a big recovery in things like Johan Sverdrup. So Sverdrup's now at a premium to 40s. I was just looking this morning. So 40s has collapsed. It looks like the North Sea is now the kind of main weak spot, let's say. But medium crude looks kind of tight. The LATAM heavy diffs have recovered from a slump in mid-April. Even spot Middle Eastern premiums have come up a little bit this week. And another one is Canadian crude, right? So for all kinds of reasons, I guess there's still maintenance going on in Canada. The Canadian diffs are really quite tight. WCS at Hardisty is quite tight. And I'm looking this morning at, for example, the landed values of Cold Lake into China or Far East. And that has narrowed massively against things like spot Basra heavy. So there is tightness in the medium crude market that is apparent, and we haven't really seen the impact of OPEC hikes yet there. I'm sure we'll see more, so that the sort of next Asian cycle starts next week, and then we'll get to see where the balance lies between perceived more OPEC supply and the fact that we're now heading into max run season, basically.
Yeah, talking about, so first and foremost, good to see kind of the 40s has finally come off. So yeah, that's been a while coming, to be honest. But look, while you were talking about kind of runs and going into the refining side, what about margins? So obviously you mentioned earlier that they're really strong. So how good is this? And again, this might be a reiteration of what we've just talked about, but what does it actually mean?
Well, yeah, so again, I think it means you should expect high utilization going forward. It's particularly noticeable in a place like Asia, also because the sort of premiums for spot Middle Eastern are generally lower than they were, for example. So that helps. And the thing that I also notice is the simple margins are so healthy. And that's where it's very important that we start to think about the direction for naphtha and fuel oil. And maybe I don't want to throw you a curveball. We can always cut it out the pod if you don't want to talk about it. But why is HSFO so strong? It seems you don't want to talk about it, but it is very, very strong. And that type of thing doesn't last forever. I would say that you get a simple margin that is way beyond the norm or way higher than normal. And there's evidence of US runs already look really good, for example. I mean, that could be just maintenance patterns. It just could be lower maintenance than this time last year, but it has been up year on year quite strongly for the last couple of weeks. So just another thing to note with regards to run rates going forward.
Okay, so prolonged kind of at the front, certainly. Everyone's probably bought crude off the back of that as well. So we'll see this kind of roll out for, another month or so at least. So look, on the Arb front, actually, you touched upon kind of Canada going into the Far East. Have you got anything else kind of that you've been watching on that side?
Yeah, I had to rewrite this morning because I hadn't checked in a day, and then things have changed a lot. So I was going to say,
the joys of markets.
The East had closed off all of the west of Suez arbs for lights and medium and sours, but it looks kind of different now. So one thing that's happened is that Dubai swaps have recovered a bit, prompt the spreads. So the EFS has come down about 60 cents through the week. So now looking at things, it's kind of a neutral arb state for things like 2P, Sverdrup, and even Mars versus spot Middle Eastern. So I'm just noting that the Eastern market did look really weak, and now it's recovered a little. So it's just an interesting perspective when we're talking about things like max runs ahead. And what degree of OPEC supply really is there. But we don't get to see the full impact until the cycle starts next week. Okay, so it's we can't say much yet. The other thing I wanted to note was, and it's in relation to high runs. So the North Sea market's weakened quite a lot. Okay, CFDs are in contango, which is interesting. It seems like there's plenty light sweet in Europe generally. And so things to note there. probably high CPC supply, probably a weaker ARB over the last few weeks to Asia, probably high TI inflows over the last month because the TI ARBs were massively open. And there's things like the Spanish refineries. I haven't heard much from the Spanish refineries yet. Jorge can maybe talk us through that. But it seems like there's too much light sweet in Europe. And what that's done is it's closed off the TI ARB into Europe. Right. So 40s as of this morning is landing cheaper into Rotterdam than is at WTI VLCC, which doesn't happen very often as far as I know. And the interesting thing is, it kind of makes sense to me. So if you could get the impression from the US stock data that US commercial crude stocks are drawing early and rather rapidly, and it relates to high runs. And so from that perspective, maybe it kind of makes sense. Like, you don't want to have the same level of marginal flow going to Europe as we did see in the last month or so. So it's kind of, let's say, a bullish signal over the next 4 weeks for the North Sea market, maybe, because you'll start to get more runs and you'll get less TI supply, for example.
Yeah, interesting. Because I was just going to say, actually, reading the notes, I was like, I wonder if we're going to be talking about kind of where's the bottom for 40s and when does that start to reverse, given TI staying domestically by the looks of it, or some barrels staying domestically. Okay, but look, anything else on TI? We touched upon kind of EIA stocks, we touched upon kind of where it is, but where did EIA stocks come out?
Yesterday, there was a draw on crude, there was a draw on commercial crude stocks, there was a draw on Cushing. As I say, that's 2 weeks in a row where it's kind of the seasonal pattern is rather strong, let's say, in terms of draws. Yeah. So, of course, it can be kind of trade flow basis as well, but it's just an interesting signal for us over the next month.
Okay, so when to watch, we'll continue to chat about it, but basically kind of all eyes on kind of Northwest Europe then, and TI and kind of what's going to happen there. Okay, so I want to stay with kind of the heavies or kind of the dirty fuels for now, if that's all right. Hua, welcome back. We missed you last week for sure. We had quite a few conversations around fuel oil that would have been great to kind of have had you on. So yeah, very glad you're here today. So look, what's going on in the world of fuel oil? I think you made a call on the high five 3 weeks ago. How did that turn out for you?
Yeah, I did make that call about 3 weeks back. Back then we saw on a Sparta blender that there was quite a bit of a mismatch between the paper Euro high five and what the blender was saying the physical reality should be. So I think paper high five back then was sort of undervaluing the physical by some $10 to $15 per metric ton. So we make the case for going long on that, which of course fortunately turned out to be right with June Euro high five. I think going from the low 30s where we make that call to now, I think it hit almost 50 yesterday. So now that the market has corrected up quite a bit, the blender is now showing that the paper and the physical are pretty much in line. So I don't really expect any sort of further big move in Euro high five from here. In other news, I was off last week, obviously, as you mentioned, but 0.5 has obviously gotten a fair bit stronger in Singapore as well. So we saw Sing 0.5 crack move off from like $10 to now hitting almost $12 per barrel. That's obviously contributing to the very strong SIBO margins that Neil was talking about just a minute ago. But crack, of course, is always tricky because you have to take into account the crude side of the equation, which we did talk about as well. Spreads have also moved up. June, July, I think is trading around $7 right now, $7.25 maybe. So yeah, it's a pretty interesting market, to be honest.
Yeah, so what's your take on the move, though? Do you think this move's justified?
I do think it's somewhat justified in the front on a sort of fundamental basis. Got low arrivals to the ARBs cargoes into Singapore in May. That's everybody talks about that. You've got some news on the fire at the ARDS and the refinery in Kuwait, etc. But going into June and July, I do think the spreads are a little bit strong, and I'm definitely getting a little bit more bearish June-July spread from here. And if you look at our blender for 7.5, the representative blender region is going to get some $8 to $10 per metric ton, including tank costs in projected forward margins for June and July, given the levels at which the blending components are going to land in Singapore. These projected forward margins are actually very strong versus historical. So it's I think it's good to remind ourselves that normally the blenders in Singapore get around, say, like $2 to $4 per metric ton in margins, and that's the sort of, like the usual, the historical average that the people get in this region. So if you look deeper into it, one big reason why the projected margins are looking very good is the heavy sweet crude. Last week I think June talked about DAR blend coming back, with 3 cargoes loaded in May. So that normally goes into a topping unit, and the flash residue gets sold as a pretty good blending component for 0.5. But we should also look at the Australian heavy sweet crude, which are just very short 10-day sail away from Singapore. And a few weeks ago, if you look at Pyrenees, I think it was looking like it was going to land in Singapore at around $11 to $12 per ton was stated. FOB dips has fallen so much recently that now it's looking to land at like $7 to $7.5 per barrel versus dated, which is that's like a huge like $4 to $5.
It's a big incentive.
Exactly. So, and the same story goes with Van Gogh and Vincent. The other Australian crews that get blended into the Villasippo blending pool. So now you've got these Australian crudes that are looking like if you look at the blender that we run, they're starting to work into the lowest cost blend recipe in the region, which is not very, it's slightly unusual because most of the time they're on the heavier, I say, more expensive sort of side in the region. So that has brought the projected forward blend cost down significantly.
Wow. So do you think the market's actually realised this, or are people kind of still a little unaware?
I think the market got very excited over, a little bit of bullish news here and there. People talked about a gasoline sort of demand story, etc. But I think the market hasn't realized the full extent of the impact of, the movements that we have seen on the heavy crude side, heavy sweet crude, from your DAR blend to your Australian crude, perhaps even some of the Chinese heavy crudes like, Peng Lai and Qin Huang Dao. People don't really talk that much about them, but they do come into Singapore, and that they get used for Villasippo blending in Singapore. So we're talking about, say, 3 Aframaxes of DAR blend, another 3 Aframaxes of Australian stuff, maybe 1 or 2 Aframaxes of Chinese crude per month. So that's some 600 to maybe 700 KT per month of blending materials for the Villasippo pool. This is pretty significant if you ask me.
That's quite
so
big.
we do see those changes in the dynamics of our blender. And another point to add is that, we saw all of those Dangote cargoes that loaded back in April that was sold, pretty decently cheap levels compared to where zinc premiums and spreads are trading at the moment. So, that's another point to take into account, because those cargoes, they're going to start landing in Singapore from June onwards. So you've got, the cargoes that are coming. And of course, we talked a little bit about that. Some excitement over some sort of gasoline demand stories that people were talking about for a bit. But if you look at the low sulfur Australian side, especially in the West, you've got stuff like Skikdal SSR, Azure SSR trading at like $5 kind of premium to ICE Brent for the latest May loaders. So that's nothing too exciting. It's a lot less than what we were getting like a few weeks ago. $8-9 sort of premium versus ICE Brent. So yeah.
Thank you.
Pretty much really.
No, thank you for the roundup. Super interesting. Guys, I'm going to come back to you all kind of at the end of the pod and ask you for your trade ideas, so you can all start thinking about what you would like to put on if you had some spare kind of cash around. But look, brilliant. Thank you, Har, for the update. I want to move on to the clean product side now, and welcome back, James. I hope you had a very good break. I don't know whether you've had a chance to listen to last week's pod, by the way, but we left last week with Neil beginning to convince himself live that the one-off bullish factors had not made much of a dent in terms of the spreads of the cracks, which could be constructed as bearish in the end. So how is Distillate performing?
I did listen to Neil's bit on the pod. It was really interesting. I guess, for me...
You don't have to flatter me, James. You fell asleep.
No worries. I guess, I'm always a bit reticent to talk about Distillate at the moment because it feels like a little bit flat. But I've got the same general feeling as when I was last on the podcast, really. Just a bit of a flat middle distillate market, maybe more interesting in jet, but in diesel particularly, just kind of gradually working its way into contango. I guess the main reason, global runs generally improving as we move into the summer. And also, the lack of just kind of seasonal heating demand, low demand, diesel demand over the summer that just seasonally happens. So in a similar fashion to crude, as Neil spoke about, we've seen like the deferred spreads in diesel globally move into contango pretty much everywhere, just past the prompt. So I think ICE gas oil, August, Singapore, August, I think heating oil from July, June even. I mean, as kind of Neil was talking about in the last podcast, you could make a bullish argument, maybe particularly right in the prompt. Like the gas oil and jet east-west are particularly narrow currently. And the HOGO is particularly wide currently. That should see some reduction in flows into Europe, for example, but it's actually how much, as we see like kind of the lull in demand, particularly in the US and a little bit in the EU, as we move into the summer, how much does Europe, the Atlantic Basin, need these extra arbs, particularly with their own runs continue to increase? And as Neil spoke about, refining margins are particularly strong now as well. And while the stocks are globally reasonably low currently, it does seem like they've kind of found a bit of a floor, and because of those improving runs, they should look to increase pretty rapidly from here. But as ever, as we've had over the last couple of summers, really, any kind of supply shocks in refining, heat issues, geopolitical issues will be important to monitor as well.
So short-term spikes then?
Yeah, indeed. I guess that's something you've always got to follow in the news anyway. But actually, something I was thinking about, something I hadn't really, paid enough attention to, is actually we saw the gas oil east-west really widen towards the middle to end of March. And I think then we saw a lot, and actually we can see it from the tracking now, we saw a lot of like Middle Eastern diesel booked to move west. That's starting to arrive now. And I think that's part of the explanation of why we're seeing quite some weakness in ICE gas oil and heating oil spreads and cracks, actually.
Okay, interesting. How are you getting on with the US demand side?
So it tends to be that actually European diesel demand stays pretty stable over the summer. And really, it's kind of that US diesel demand is the one that starts to really come off into the summer as we get the less heating demand. Diesel demand seems to be quite at kind of normal levels in the US currently. I guess there's some fears about sentiment because of the tariff-induced fears in the market over the summer. Actually, to be fair, jet demand in the US has actually been quite strong. But still, kind of those two things, really. So reducing US demand, increasing US crude runs, which are going to be probably very stellar because of those refining margins that Neil spoke about. I think we should expect to see quite high levels of US Gulf diesel move into Europe over the summer as well. And I kind of don't want to kind of repeat something that that is kind of a bit amorphous, we don't know much about, but it's going to be important to monitor supply shocks over the summer. Again, heat issues, geopolitical issues. I mean, there seems to be some modicum of stability when it comes to flows from the Middle East currently in the Middle East. But actually, the political situation doesn't look actually that very stable currently. So I guess that'll be important to monitor.
Fair enough. What's happening on the ARBs front, James?
So it's actually, if you look at like Middle Eastern diesel, the ARBs margin wise, really that should be pointing east currently. But actually what I was trying to say there before about the widening we've seen in the east-west towards the end of March, beginning of April, is actually we're seeing a lot of this diesel still heading west currently. Actually, I'm a little bit surprised about that because a lot of I think some of that move actually right now is a little bit out of the money. But anyway, we've been seeing still a lot even though pointing east margin wise, we've seen a lot of that flow pointing west actually. And I think that explains some of the prompt strength that we're seeing in Singapore diesel spreads over the last period of time. AG West Coast India jet, that continues to head west and has been doing for a while, and is actually open into Europe and the US Atlantic coast as well. Actually, the US has actually witnessed, because of that stellar or improved US jet demand, we've actually seen quite a correction from those high jet stocks to kind of average jet stocks over the last month or so. And something that probably Michael would know more about, but we've kind of really seen a real weakness in US Gulf MR freight rates. And despite like poor Brazilian diesel premia, this is helping to point a lot of US Gulf, from those increasing crude runs, US Gulf diesel to Latin America currently. But actually, despite the wide nature of the HOGO that we spoke about before, actually these ARBs are also open into Europe in the prompt as well. So that kind of just adds extra factor that I think we're just going to see high exports to Latin America, but also not limited exports to Europe over the summer as well. Just adding more to that bearish view that I have. So yeah, I guess overall that kind of leads me into my general view. I just have like a moderately bearish view. I just think we're just going to continue to see like just a gradual reduction in spreads move into contango over the next month to 6 weeks, bearing in mind any potential bullish hiccups that could happen in that time, supply shocks, etc. And I guess the next thing we need to be looking at is like when we maybe start to see like global refining start to go into turnarounds again, maybe Q3, end of Q3, then to look for the next turning point.
Okay, all right. Me. Yeah, one to monitor. James, I'm not used to you being kind of bearish, to be honest. Makes me sit a little bit uncomfortably, but yeah, thanks for going through that. So,
no worries.
Jorge, why don't we move on to the light ends part of the barrel? So, welcome back. What's been going on in gasoline?
Yeah, I think the main thing that we have seen is a global correction during the last week. I think the market that has felt it more has been the European one. So we have seen a downtrend in the EBOB time spreads and crack recently. Let's remember that we come from a very strong month since the beginning of April. It has been a little bit the same in the naphtha market, but naphtha market has different fundamentals right now with the LPG history from US to China. So let's focus on the EBOB correction. We have seen a very strong market, but the physical premiums for components remain very low, especially on reformate. We have been talking about this for the last month, I would say, and they are especially low if you compare it with the last 3 years, because after the war in Ukraine started, we have seen very strong prices for some high aromatic components. Right now they are very low. We have a light reformate at plus 40 in the prompt. We have seen levels above 100 in the previous years, and if you combine these cheap components with the last uptrend in GasNap, what we have seen is the E10 blending margin being open in Europe. That means that it's profitable to go to the prompt market and buy components, blend them, and sell it in the window. And that's obviously bearish for the EBOB companies because it means more product stay in the region and less product is exported to another regions. So we have been seeing this indicator open for the last week, for the last 10 days, but right now it's much more open, and there is a threat that E5 blend margin could be open if the market remains like that. So that has been bearish, and that has set a ceiling for the current uptrend in time spread and cracks. And if you combine this with low export options right now for Europe and increasing barrels that could come from the east, because right now the east is the AG and Singapore are shipping into some key destinations for European barrels. So you have a bearish, or at least not as bullish market as we have seen during the last month and a half.
Fair enough. So look, what has been the main changes in terms of the arbs that you mentioned just now?
Yeah, we've been talking about Nigeria, where Singapore was very close to a delivery price from Europe. Obviously, we are comparing LR1 from Singapore to MRs from ARA. And this is especially relevant when Dangote looks to have issues in the short term, so more supply should come from Europe or from the east to West Africa. We were talking about Singapore. It remains very competitive, less than $1 per metric ton difference with a delivery price from ARA. And right now we have AG also. After the last price movement in the blending components in AG, we are seeing also very close the delivery prices from AG to ARA. So it means that the Eastern barrels are more competitive into ARA than the previous week. And then looking at the other part of the Atlantic Basin, we have Mexico, where Singapore has been cheaper than US Gulf Coast for the last weeks. And right now, the difference is huge. It's more than 4 cents per gallon, close to 5 cents per gallon, if you look at a delivery in the middle of June. So it means, Singapore, after the downtrend we have seen in East-West for the last month, right now it's very competitive into Mexico West Coast.
Oh, so how are the East-West spreads behaving right now then? Any signals of improvement there?
Yeah, not yet, but it's it looks like it's finding a bottom during the last session. It haven't dropped for the last 4 or 5 sessions. A little bit of rebound in yesterday's session, but yeah, we come from a strong downtrend for the last month. And yeah, if you if we link it with the previous comments about the ARBs, it looks like it could find a bottom soon and rebound from the current low levels. If you look at the seasonal levels, it's below the historical average. It's well below. So I think there is room, and more with the current arbitrage picture, to see higher level of East West in the coming weeks.
Okay. Looking forward to hearing your trade idea kind of shortly, by the way. But so look, what's the outlook for the West then, moving kind of regions, especially with low US inventories?
Yeah, right now, I think as I said, the Singapore 92 market and the East West look like the more bullish or potentially bullish indicators in the short term. In the West, we have this story about blending margins being open in Europe, and in US we have a low stocks story. If you look at the total inventories, they are below the historical average, but it's not something dramatic. But if you look at Path 5, they are well below the historical average. So the ARB from Europe right now, it's not open if you look at Path 1, but it's close to be open for blenders. We have seen this very tight margin, close to flat for the last weeks. And if US runs, they are expected to run to increase, in the short term, and they should be able to fill inventories. But if they cannot be there in the coming weeks, maybe we could see the ARB opening from ARA, especially if the complex is under pressure due to the blended margins being open. So there is a potential bullish story there in the medium term. As I said, in the short term, I keep thinking that East West is the main indicator. But yeah, if we see the ARB opening from ARA to New York Harbor or to Path 5 in the coming weeks, there is a potential bullish story also in the arbitrage in the Atlantic Basin.
Okay, so a few positives to take away from that then. Thank you, Jorge. That was really great. Look, from each of you, usually we do the whole 3 things that we're looking at in the market. I think I turned that around kind of a couple of weeks ago, and last week we talked about recession. So this week, I just want one trade idea from each of you, and maybe we can follow up on it kind of next week in terms of how that's working out. So Jorge, as we've rounded up, we'll go back through the barrel. So trade idea from yourself, please.
Yeah, well, I think I have already said it. But yeah, I think that East West could find a bottom and rebound a little bit during the coming weeks.
Okay.
And the main fundamental is the arbitrage being open to some key destinations.
Okay, cool. All right, we'll check in on that one next week then. James, on your bearish distillate kind of view.
I guess I'm going to maintain that I'm bearish ICE gas oil and heating oil spreads.
Okay.
And I guess I'm more bearish heating oil spreads. So I guess I'm also bearish the HOGO.
Right. Yeah. Oh, you've given me a collection there. Thank you so much. Hua. Oh, sorry, James. In the prompt, right? Are you looking at that throughout the summer? Yeah, cool. Hua?
Yeah, I'm getting a bit more bearish. 6.5 spreads. I think there's still maybe a little bit more to go. These markets tend to kind of overextend in one direction and then flip back to the direction. But I don't think that's particular to 2.5 or fuel oil, but a lot of markets. So I'd say if you're long 6.5, maybe it's time to start exiting, and then maybe wait for a little bit and then put on sort of like a more bearish position.
Okay. So you're going to bridge that gap then, get out of your position, and then re-entry in a couple of weeks or a week.
Even exactly, even probably shorter than that. So.
Brilliant. All right, we'll check in on that one next week. And Neil?
Maybe two prongs to it in the same type of topic. I guess I wouldn't want to be short Brent prompt spreads just now. And then I'm just thinking about what that means for TI Brent, because basis what we talked about in terms of the TI ARB being closed, you would think that paper TI Brent needs to widen again because it's quite narrow now. It's minus 330. But I'm not sure that can be justified looking at the direction of US stocks. So it would be something like TD25, because I think we have a fairly long Afra tonnage list in the Gulf Coast, and TI is closed. So I guess something like TD25 to drop off even more to try and stabilize the situation in the North Sea.
Okay. All right. Brilliant. We'll check in on that one next week. Anything else from anyone else? If not, we can wrap up this week, I think. So brilliant. There we have it. So thanks as always for tuning in to Sparta's Market Outlook podcast. If today's discussion sparked any new trade ideas or helped clarify some of the moves in the market, we'd love to hear from you. So drop us a line, please share the pod, and don't forget to subscribe so you never miss us. Until next week, stay sharp, stay curious, and keep your positions nimble.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.